Okay, welcome back to Hurdle Rate. And right now we're going to build part 2 of this this model. If you followed along in the other video, we built out the cost of equity. Let me just make that a bit neater. We built out the cost of equity, and with that we're able to build the WACC. So we have those now. Let's go in and start building the DCF. So, as always, with first thing we do, page layout, we take off the grid lines, we go view, we freeze the first column, we insert another, and we just make the A smaller and the B larger. And in A1, we're going to put Lulu. I'll just zoom in for you. I always forget to do that. So we have Lulu here, data, stocks, and it will automatically find Lululemon for us. And there we go. So the first thing, as always, is ticker, date. We want the current price, the implied, and then we want to know if there's any up or downside. So the ticker is equals A1, parentheses, ticker symbol, close, and we go. And the date today is, let me check, 28th of September 2025. The current price equals, again, A1, parentheses, price, and it's 176. Okay, that's fine. Sorry. Border, we want the dash, not the dot. We want it inside as well. Fillet, color. Let's go this one. Let's go. Do the same here. I think if I just copied the formatting there, it would then change the formatting in the cell, so it wouldn't be a currency. And it sometimes, annoyingly, it's a bit quicker to just do it like this. But with this, we can just copy it over because we haven't done anything with it yet. Okay, looking good. I'll zoom out a little bit because we want to probably get to about K. You just fill this with, then we want the font to be white. And these are assumptions. Oops, sorry, my wire just fell. So segment, call it revenue segment. And there's only going to be 3 for Lululemon. Which is, it's going to be women's apparel, men's apparel, and I think accessories. And we want bare, base, ball. Just copy this. What did I say? I think it was 3. Revenue segment, yeah, so women's first, which is the largest by quite a long way. But as we said yesterday, the men's is now saying something. Not to spoil it, but it's about, say, 25% of revenue. We can see it here. Yeah, so it's definitely substantial. We want EBIT. Remember, we're doing free cash flow to the firm. So we're not, because Lululemon doesn't pay a dividend, we don't really need to see what's available left for the equity holders. We want to see how much free cash flow generated for which they can spend on the company. So we have to use the pre-debt version. go. Looks good. And in the bear, we're going to put it, say, 95%. Even though if you look at previous sorry, I can't multitask very well. If you look at previous earnings report, it hasn't been pretty for Lululemon. I'll just show you the chart. I mean, I remember back in a few years ago, the share price was significantly higher. I think it was near 400. Now it's 176. As we've got up here. Let's let that load. Just keep building. There we go. And this is a revenue build. If we go back 5 years, see, look at that. It was over 500 at one point, and now we're down at 176. So it's been a huge, and you can't really sort of put this down to just being the tariffs, because I mean, it was since the start of 2024, it has been going downhill. And a lot of people are saying, one, obviously the tariffs play a part, but it's also that there's some good competitors out there that are gaining market share, and that actually Lululemon is no longer the best in class for this genre of apparel, for athleisure. So what is it? Bear, base, bull. We want to look at percentage of revenue, and actually the percentage of revenue is going to be very important, because predominantly this was a female, mainly a female brand, until it started. I mean, as we just said, the men's segment is growing quite a bit. So yeah, we'll have to see what happens. Equals B12. Okay, yeah, it looks good. We're going to start with 2022. Do we get it yet to 2030? There's no point going beyond that, because, for one, you can't really forecast that far out anyway, but also, I mean, I think it's a fairly established company now rather than a growth Lululemon, so it's best to do that. Okay, look, they've the stores. Interesting. Okay, what do I want to look at? We want to look at the income statement, but we want it broken down by product category rather than region, or I can't remember what the other one was. It's quite nice when you get a statement like this that does break down the revenue into so many different ways. Sometimes it can be hard to find, but it's okay. Okay, I'm going to pause. I'll come back to it. Okay, I found it. It was at the very end. So if you're on the most recent 10K, it's on page 79, and here we are. So let me. Oh, no. Come back. There we go. Yeah. So it's the disaggregated net revenue. So women's product, men's product, other categories. We're going to call it apparel though, because that's what it is on the most recent financial statement. Oh, I'm on the wrong one, am I? Let me just see. Okay, yeah, so I was actually on the wrong 10K. So we want 24, 23, and 22. So let's start filling this out. We've got, so women's 55259.803. Remember, this is in thousands, not millions, as it would be, say, for Apple. So we just need to make sure that we get it right. We don't do it like this. We do it 5259 point, because we're doing the statement in millions, not thousands. There we go. 52. Then we want 6147.372. 6692.630. So to work out the growth, we go equals 20 the year, well, yeah, so the most recent year divided by the year divided by the previous year, and subtract 1, and we just format that into a percentage, and we can go copy it along. No, we just want it up to 2025, and we do it like that. And also, whilst we're at it, let's just copy the formatting onto down here, and we're good to go. So men's product 1956.602, 2252.753. Oh, sorry, 2252.753, 2558.380. And yeah, we just copy that down and it automatically does it for us. 37, so 894.113, 1219.153, 1337.116. Looking good. Yeah. And this is just for the total revenue. I'll get that ready now. We go total revenue, bold, percentage growth, and it's easy. You just go sum. And do we have that right? Yeah, it's just over 8 billion a year. We copy it all the way along. Yeah, all good. And again, don't worry about these errors down here, because once we start filling in the rest, they will automatically clear. It's just that there's nothing there at the moment. I mean, okay, well, it's not bad, is it? 19% growth, 10% growth. Let's see what 2025 is, or what 2025 could be. So the first 2 quarters. So last year, it looks like they do better towards the end of the year than at the start. So 6693 divided by 291.362, 22, so that's about 2.3, equals 3082.493 multiplied by 2.2988. So so the women's will grow. I mean, yeah, it is coming down quite a bit. I guess the growth rate, which is what priced everyone was probably assuming that it was going to have these 17-15% constant growth rates for much longer, but obviously that was not the case. Equals 2558 divided by 1093.223. Sorry, one sec. Why did that not work? 1093.223, 2.34, 1169.386 multiplied by 2.34 sorry, that should be 218. There we go. Now accessories and other. We have to be careful on this one because we can't, I mean, we're not going to assume that it's going to be doing, actually I think it might come out as a fairly sensible growth rate, but let's see. So 1337, 575, 0.384, 2.32. My bad. So 12%. Okay. It's not bad. I mean, so for 2025, we'll probably forecast that it will do 11.3 billion in revenue. So based on that, I mean, if the market cap, as we saw yesterday, is about 20 billion, it's trading at 2 times sales. I mean, it's not offensive. When you're seeing it, 8-9 times revenue, you're thinking, well, it's a bit steep. No, what do I want to do? So equals average, 11%. And let's say this stabilizes at, so by 20, okay, let's say it's 5%. What would we call equals G10? If you remember how to do this, it's you go equals, take the previous minus the previous minus the final year, close brackets, divided by the final year minus the previous year. But the way we need to do this, so we lock this one in. Actually, no, what do? We lock the column in, but we leave the row because when we copy and paste it down, we want it to automatically update there. But for this one, we lock both in because this will always be there irrespective. And on here, it would just be the row that's locked in. Now, okay, it's going to make the column big, and I need to column width 10. Let's just format this so that they're always 2 decimal places. So it's a percentage, but 2 decimal places. Perfect. Looking good. There we go. Now we do multiplied by, I think it's E10 for the bear. There we go. And always lock this cell in because we're going to copy it across and we want it to always be using this cell rather than moving across with it. There we go. And we just put I10 here. Whoa. But it needs to be G26. There we go. Perfect. Now, okay, what we want to do is when we're filling out the forecasted growth rate, so we use these switches, and these go from, we just put 1, that's for the bear case, 2 for the base, 3 for the bull, and that's going to allow us to simulate between these different growth rates, so that we can, well, if it grows in a bearish way, we can see what the implied price is. So let's use this function called offset equals offset, and you then select the cell that you're in. So in this case, it's G24. Then you put the switch in, but lock that. So lock that C10, and make sure it corresponds with where your switch is on your spreadsheet. And then you just put a 0 at the end. I don't know why, but that's how it works. So we have 11%. Well, let's just copy it across first. Let's complete it. Let's forecast the revenue. So the forecast for the revenue is just you take the previous year multiplied by 1 plus the growth rate, and you just copy that across, and there we have it. Now what you'll see is we can go, so remember these figures here. That's on the bull case. Let's go to the base. See, it's a bit lower. And on the bear case, it's even lower. And this not only dynamically does this section, but it will then do for here as well. So if we do this 3 times, somebody might be bearish on the women's, but more bullish on the men. So we can put a 3 on the men's and a 1 on the 2. And then that can help us simulate what we think the revenue is going to be. This needs to be G11. But I think, but let's be a bit more bullish on the men's because it's a smaller part of the business at the moment and it is growing. So, okay, yeah, that looks good to me. Yeah. We can just copy this down and we change it to C11. Copy it across. And then the same with here. And always just make sure to double check that when you're doing just a copy paste, just to make sure that it looks right, that it's not just copying it from women's, but it's actually putting in the correct figures for the men's category. Okay, yeah, that's good. Let's do the same for the accessories. And accessories, I mean, again, what would you say it's going to do? 15% maybe? It's a smaller category, so it's got significantly more room to grow. And I guess with accessories, there's so many different things it could put in there. It can encompass so many different types of products. C12, let's go. Yeah. Okay. Now, as we said, we want to as well look at what say each category is as a percentage of total revenue. So we go onto that row, and we take the women's apparel revenue and divide it by total revenue. So that is 65%, sorry, and we can see how this can trend over time. I mean, so the men's is on the forecast that we're giving. But so let's put women back onto the base case rather than the bull case. I mean, it looks like it's going to sort of stay, I guess, yeah, stay the same. That continually it's going to it's never going to be more than a quarter of sales, and I wonder whether that will be the case. And then yeah, I think accessories, you kind of have to say that there's significantly more room to grow because they could do things like weights, yoga mats, water bottles, all of these things that can grow revenue, and they'll still be fairly highly priced because it's Lululemon is a premium brand. Okay, I mean that's the revenue built out. We're on 11 billion now, and we're forecasting it to go up to just over 18 billion in 5 years. It's not stratospheric growth, but yeah, I think it's okay, looking good. Well, let's go into the income statement now. Oh, sorry. And this is, I mean, the income statement is probably the most, well, it's not the most, I guess all of it's important really. That's, yeah, so revenue, no, sorry, it doesn't need to be, we can just type revenue. And we go equals, just copy it along. There we go. And we always want to link this to this, because when we change it with the switches and this updates, it needs to update on this part as well. Yeah, that's important. So it all needs to be linked. Otherwise, when we do it and it comes down to the actual, say, share price at the bottom down here, we're not going to be able to simulate different things if it's not all linked. EBIT, that's your operating income. I want to know what this is as a percentage of revenue. Where's their income statement? So income from operations is what we need, but let's do the previous years first. So this is the balance sheet. This is the income statement, and the other one is not that one. Then this is the cash flow statement. And we need all the parts from all three to be able to build a DCF, but we don't need much from each. So income from operations. Oh, this is really annoying when they do this. 23, 24, 25. But really it's for the year 2022. So let's just keep it like that. Otherwise, let's. I know it's slightly wrong, but it's confusing when you have to put the end of the year being January 23. 1328. One, 3, 2, 8. Oh, so in here they took a huge loss on a what was the thing? Did they buy? I think they bought a. Was it? I think it was a company called Mirror or something, and I think they acquired it for quite a lot of. It was quite a big acquisition, and it didn't really work out. So I think they had to write it down here. But otherwise, I mean, you'd expect the income to be closer to this level rather than here. So what am I looking at? 2576. No, I'm not. Sorry, 2505. 1697. There we go. Yeah, so the margin here was 16%. Really, they want it to be closer to, above 20s. So if that was divided by 97, 2.5 equals multiplied by 2.57557757. Okay, and for now we just do the average. And then when we're actually building on the DCF section, that's when we make it more dynamic. So income tax expense 477.771. Let's have a look. Divided by, what was it? Income tax expense 299. 298.485 multiplied by 2.53987.965. And to forecast the tax out, you just go take the forecasted EBIT and multiply it by the forecasted tax, well, percent of EBIT, which is the tax rate. There we have it. Now we park this one for a bit and we go on to the cash flow items. And they are depreciation and amortization, percentage of, then what was the other one? CapEx, capital expenditures. Then we want the change in net working capital. I'll just call it the change in NWC. Okay, and these are all found on the cash flow statement, which, as we mentioned earlier, is this one. So depreciation and amortization, that one's clear. Purchase of property and equipment is the capital expenditures. Then the, this is really annoying. The change in net working capital is, well, are all of these, and we just do the sum of all of these, and then we put it in. So, right, so let's, where's it gone? Okay, the first one, so for 2022, it's 291.791. And again, always format. Then we have 379.384. The CapEx down here. Oh, it's spending big, 638.657. $651. Then the change in net working capital. Oh, it's going to take ages. Okay, so remember all of these, you just sum them basically. Some of them are negative, some of them are positive. So let's get started. Equals, remember, we have to put the point in because this is in millions, we're working in billion. No, this is in thousands, we're working in millions. So 58.987. And it's negative, minus 573.438, minus 66.714, minus 54.833 minus 36.518 minus 107.280 plus 65364 plus 47.254 plus 35.986 plus 68.266 plus 23.905 minus 2.925. Okay. This is actually good in terms of free cash flow. When this is negative, it usually means they have, say, favorable terms with their suppliers, so they can they don't have to pay for the product immediately. They don't have to pay their suppliers immediately. They could have, say, a good grace period, meaning that they're so well, it just improves cash flow, doesn't it, if they don't have to pay immediately. Equals 6.580 plus 66.584 plus 1.908 plus 40.587 minus 53.280 plus 177.367 minus 71.734 plus 70.327 minus 173.196 plus 84.315 plus 37.535 plus 12.230. Last, well, penultimate, 1.626 minus 156.085 minus 2.031 minus 71.789 minus 73.205 minus 57.044 plus 193.139 minus 112.110 plus 157.205 plus 42.410 plus 23.501 plus 2.488. There we go. Okay, let's just do a bit of housekeeping on the... So we want to know what it is as a percentage of revenue. We want to know what DNA is as a percentage of CapEx. And the same for the change in net working capital. Okay, now, same with this one. Just bear with me. It's fine, it's all good. Let's not worry. Okay, depreciation and amortization. Divided by 199. Okay, so 234.244 multiplied by 2.2401. Same for CapEx, let's see what it's doing. Here it goes. When we're doing this, we're just finding out what the ratio is for 2024 halfway through the year. So if, say, for example, revenue was 1 billion in the first half of the year and it ended at 2.2 billion, we'll know that revenue increased for the second half of the year. So we want to factor that in our forecast for the following years. I mean, it's not a foolproof way of doing it, but for now it's okay. Unless we had a bit more concrete info on what the sales forecasts are going to be, then yeah, this is the way we'll do it. Divided by 275.767. $2.499,327.33. I mean, it is going up, CapEx. Change in net working capital. Let's just do it as it is. Let's not try and divide this. I mean, we'll see. We'll see how big a number it is. But for this one, you can't really do anything. Minus 33.330 plus 91.154 minus 131.640 minus 61.249 minus 165.214 minus 59.616 minus 2.776 minus 30. Okay, Lura. Well, when we're forecasting it out, we'll take an average, and then that can be. But we'll see. We'll see. So. We're expecting, yeah, depreciation and amortization to be about 4% of revenue. So let's take the revenue. Do the same here. CapEx to be about 7% of revenue. And for this one, let's take an average. So if we give for change in net working capital, it's so much better when you have the full year results to be able to forecast out, because mid-year it's a bit messy. But I mean, it's looking good for free cash flow though, if it's negative. So, okay, let's DCF. Now the rest, up until we start once we get the unlevered free cash flow, a lot of this is now just copy paste. So revenue equal revenue now. Let's build out the EBIT simulator. Equals no. Just copy this out to 2025. And we want our box from here. And we're getting, I mean, let's what does it need to be? What would we call this? Let's say 22%. Let's say it holds that margin. And it's G14. Just copy that along. Looks good. And again, it's going to be equal offset. The cell that we're in, G77, lock it in, so the $ C, lock it in, 14. There we go. Just format it to get it percentage, pull it across. Now, oh, sorry, there we go. Equals revenue multiplied by the margin. And this will, again, automatically, this will dynamically update as and when you go on a bullish, bearish, or just a base case. And we now bring in our taxes. But just pull them up to, sorry, can you see? Just pull them up to 2025. And take them to there. Now let's take an average. And then you take your EBIT multiplied by the tax rate and pull it across. So now obviously this gives us a dynamic way of simulating the taxes. And we have that. Now we're going to create what is called the EBIT. We're not really create it, we're just going to calculate it. EBIT, the earnings before interest but after tax. And that is calculated by, well, we're only going to do it from 2026 onwards, what we're forecasting out. So yeah, how do we, it's easy. We go EBIT minus taxes. Bold it, pull it across. And what do we want now? DNA, CapEx, what's the other one? Change in NWC. Looks good, looks good. Okay, now it's easy from here. We just take the, we're going to calculate the, what do you call it? The unlevered free cash flow. Unlevered free cash flow. And to do that, we take the EBIT, we add back in depreciation and amortization because it's a non-cash expense. We take away the CapEx and we subtract the change in net working capital. And that gives us our unlevered free cash flow. We pull that along. And what we're going to want to do now is, from what we built earlier with the WACC and the cost of equity, we want to discount these cash flows back to the present, back to today, so that we can well, work out what it is worth. So before we do that, let's come back up to these boxes. We're going to put, so let's start here. The terminal growth value, most people usually put in 2.5%, but never let this number be more than GDP growth. For the bear case, put it as this one minus 0.5%, and you put the, so you put the base plus 0.5% for the bull. Then the WACC, we have our WACC here, so equals WACC. And for the bear case, you add 0.5%. No. And for the bull, you subtract 0.5% because the lower your whack, the less risky it is. So whack. So now to make all of this dynamic, we go equals choose, similar to offset, but we use choose for this one, and we just go through this row, and we just put a comma after each cell that is populated. Oh no. There we have it. Then just pull it down. Perfect. And also, if you've been watching the other videos, I would like to put the years above here. So we have the actual year, but we want that in a form that we can use when we put to the power of. Now, okay, easy. So we go the present value of the unlevered free cash flow equals, we take it divided by 1 plus the whack, close brackets, to the power and before we put it along, lock in your whack. Then just put it along. Now we want the terminal value, and that is equal to, you take the unlevered free cash flow multiplied by 1 plus the whack divided by the whack minus the terminal growth value. So this is saying the terminal value. So once we start going on to that terminal growth value of that 2.5%, this is what, in perpetuity, this is what the company will be, this is what Lululemon will be worth based on the cash flows we've generated. We want to find a present value for that now. So go PV of TV, and you do 59 divided by 1 plus the whack to the power of the final year, which is 5. Hey, why isn't it showing? There we go. Now for the enterprise value, that is going to equal the sum of all of the present value of the cash flows forecasted, and including the terminal value. The present value of the terminal value plus the present value of these free cash flows. Now we go, what do we want to do? Add cash minus debt. And if the debt we're going to put as what was on here, and there's no debt as far as I can tell, then the cash, where is it? Cash and cash equivalents. Yeah, so 1.115 billion. And they have, so 1155.794 in cash. And from this, we can get to our equity value. And all that is you take the enterprise value, you add back in the cash, and you subtract the debt to give us 51.5 billion. And from here, I'll bring all of this a bit closer. From here, we can, this is why I like to freeze the pane so that we can do it, and I'll zoom in a bit more. So 1 second. Okay, yeah, that looks good, sorry. Diluted shares outstanding. That, no. Okay, let's put implied share price to the diluted shares outstanding you find on the income statement. You find it here. We're going to look at the 2 quarters ended diluted weighted average number of shares outstanding. There's 120 million point to 2 point, so 120.262. Now the easy part, you go equity value divided by diluted shares outstanding, and we get a share price of 428.2. And this is on a base KK, so what's that, K109? Okay, so the up and the downside here is you do this one, the implied divided by the current, minus 1, and percentage. So it's, I mean, this is on a base case as well, so that what happens, okay, what would the bear case be? Let's always start with that. $343. So I wonder if, I mean, have we been too generous on the, oh, I don't know, maybe it is the bull case. 553. I wonder why it's so. It's probably this. I don't think this is going to be negative throughout the next however many years, even if it was for the previous 2. We'll have to come back once we get the full 10K in January, and we can see, I think it actually comes out in February, March, and we can see what this number is. Because obviously it's having such a positive impact when you subtract a negative, it adds it back in. So it does add to the free cash flow. Does it do it substantially? I mean, yeah, I guess so. Then maybe we're being. Do we think over the next 5 years revenue is going to increase from 11 billion up to 18 billion? I mean, that's quite a. It's adding 7. What would that be? Sort of 65-ish% revenue over 5 years in total, not yearly, obviously, but. Well, we'll have to see as well the impacts of the tariffs on the next couple of earnings reports and see if that is genuinely having the negative impact that saw. Because for it to be down here at 176 and have such a high upside is yeah, it's quite a. We'll have to see. I mean, obviously, this is not a foolproof way of calculating. We're looking at it. We're looking at what the value of the company is based on the cash flows it produces, and we're putting in our own forecasts. So when you do this, you have to combine it with, I say, other research as well, not just what's happened in the past. You need to understand where it's going, so that you can see if it is, if it does, yeah, what do you call it? Yeah, I mean, okay, well, yeah, let's monitor it and let's come back to it in a few months and see where it is. But I mean, it's always quite nice when you see it like this as being 100, potentially on a base case scenario, 140% upside. But we'll see, because there's a reason it's trading at 176, and that's because it's very, very pessimistic. I mean, if we'd gone on these past figures, then yeah, we would have where it was trading at a couple of years ago when it was hitting the 450, 500 mark, because they were going on the past, but they anticipating this to come down significantly. So yeah, let's see. And maybe I think margin compression could be the big one. if we were to, for example, put this down to 20%, what happens? No, sorry, I did it on the wrong one. Don't do it there, do it down here. Let's go 20%. No. Yeah, 394, 311. I mean, look, there's still a lot of room for this to... There's still a lot of... I mean, the margin can get absolutely battered, and it should still be okay. I mean, what happens if the EBIT margin goes down to 10%? See, I mean, there's still upside. Okay, well, let's see. Thank you for listening, and I'll see you on the next one. Bye.